We're talking about how to actually achieve financial success. And right off the bat, we need to completely reframe how we think about this. We've got to stop this endless chase for quick money. Being financially successful, it's not about landing that one incredibly lucky investment, and it doesn't require suddenly landing a multi-million-dollar salary. Instead, it's a highly predictable, highly repeatable system. And honestly, the best part is that it's a system you have total control over. So think about this for a second. What if financial success had absolutely nothing to do with getting rich overnight? I know, it's a huge paradigm shift. Society is constantly feeding us this myth, right? The overnight millionaire, the crypto billionaire, the lucky lottery winner. But that is simply not how actual, sustainable financial security is built. It's built on a very steady sequence of specific actions. Once you finally stop chasing that illusion of overnight success, you actually free yourself up to build something real. So here is our roadmap for today. We'll start with step 1, the financial success ladder. Then 2, protect your foundation first. 3, control debt and grow income. Hello, everyone, and welcome to today's explainer. I am so incredibly excited to jump into this one with you because look, we are tackling something that impacts literally every single one of us. We're talking about how to actually achieve financial success. And right off the bat, we need to completely reframe how we think about this. We've got to stop this endless chase for quick money. Being financially successful, it's not about landing that one incredibly lucky investment, and it doesn't require suddenly landing a multi-million-dollar salary. Instead, it's a highly predictable, highly repeatable system. And honestly, the best part is that it's a system you have total control over. So think about this for a second. What if financial success had absolutely nothing to do with getting rich overnight? I know, it's a huge paradigm shift. Society is constantly feeding us this myth, right? The overnight millionaire, the crypto billionaire, the lucky lottery winner. But that is simply not how actual, sustainable financial security is built. It's built on a very steady sequence of specific actions. Once you finally stop chasing that illusion of overnight success, you actually free yourself up to build something real. So here is our roadmap for today. We'll start with step 1, the financial success ladder. Then 2, protect your foundation first. 3, control debt and grow income. 4, invest and diversify. And finally, 5, the power of time. Let's dive right into section 1, the financial success ladder, a system so simple an 8-year-old can understand it. This framework is wonderfully straightforward. It isn't about complex Wall Street jargon, it's just the fundamental laws of money. Step 1, money comes in. You have to know where it's going. You know, a budget really isn't a punishment, it's literally just a plan for your money before it disappears. Step 2, some of that money protects you from surprises. Step 3, your expensive debt gets smaller. And step 4, some money is invested for the future. The absolutely crucial point here is the order of operations. You just can't successfully invest for your future if you haven't first protected yourself from surprises or handled your expensive debt. Let's talk real numbers for a second and look at what we actually spend. If we pull the 2024 data from the US Bureau of Labor Statistics, the average annual household expenditure was $78,535. Now, what are the 2 biggest slices of that pie? Housing averaged just over $26,000, and transportation was over $13,000. Together, those 2 categories consume more than half of the average household's entire spending. So yes, you can absolutely stop feeling guilty about your morning iced coffee. Your daily latte is not what's keeping you from buying a house. The real, massive financial wins come from managing those major recurring expenses, where you live and what you drive, not obsessing over tiny everyday purchases. To see this in action, meet our fictional average earner, Alex. Let's say Alex was earning $60,000 a year and just got a fantastic raise to $75,000. Now, Alex faces a major choice. Do they try to look rich by immediately upgrading their apartment, getting a newer car, and buying a new wardrobe to match that $75,000 salary? Or do they choose to actually become financially secure? Well, Alex makes the counterintuitive choice. They keep their old $60,000 lifestyle for a while. By avoiding that trap of lifestyle inflation, Alex instantly creates a massive gap between what they earn and what they spend. Which brings us perfectly to section 2, protect your foundation first. This is all about building your cash safety net. So what exactly does Alex do with all that extra money from the new raise? Before doing anything else, they absolutely must protect their foundation. Your emergency cash needs to sit in FDIC-insured accounts, like a checking or a high-yield savings account. The FDIC states your deposits are automatically insured up to $250,000 per depositor per insured bank, meaning it is perfectly safe. Invested money, on the other hand, like stocks or mutual funds, carries risk. There's zero FDIC protection if the stock market takes a nosedive. Your safety net must be in cash, completely shielded from all that market volatility. Okay, so how much should actually be in that safety net? Well, research from the Consumer Financial Protection Bureau and Investor.gov points to a general target of 3 to 6 months of living expenses. Why that specific amount? because the data shows that having that cash buffer is exactly what prevents one surprise medical bill or one major car repair from completely destroying a household's financial stability. It stops an unexpected shock from instantly transforming into a nightmare of high-interest credit card debt. Moving right along to Section 3, control debt and grow income, shrinking the bad and growing the good. Once your foundation is completely safe, we climb to the next rung of the ladder and attack this on two fronts. First up, defense. High-interest debt literally traps your future income. Think about it. Every single dollar you pay in 25% credit card interest is a dollar stolen straight from your future self. You've got to eliminate it. But financial success isn't just about extreme frugality and playing defense. You also have to play offense. Focus heavily on improving your skills, seeking out education, getting certifications, and negotiating your career moves. Growing your earning power is just as important as cutting expenses, exactly like our friend Alex did to jump from 60K to 75K. Now, there is a really important nuance to mention here. You need to avoid framing all debt as equally bad. A 3% or 4% fixed-rate mortgage on a home is vastly different from a 24% revolving credit card balance. The real strategy here is to brutally prioritize crushing that expensive, high-rate debt that rapidly eats away at your financial freedom, while just appropriately managing those lower-rate, longer-term obligations. All right, Section 4, invest and diversify. This is where we start putting your money to work. With the expensive debt totally gone and a rock-solid emergency fund in place, Alex can transition completely from defense to offense, $24,500. For context, the IRS states that for 2026, the employee elective deferral limit for most 401k and 403b plans is $24,500. U.S. tax-advantaged accounts provide a truly brilliant, structured way to save. And hey, if your employer offers a matching contribution, that is literally part of your compensation package. Capturing those workplace benefits is an absolutely massive step toward long-term wealth. And here's another incredibly powerful tool for 2026. $7,500. That is the current IRA contribution limit. Now, I want to be super clear here. These are just the legal limits for structured saving. They're not mandatory amounts you have to hit right out of the gate. The whole point is to just use the tax-advantaged tools that are available to you so you can begin systematically investing a portion of your income for the long haul. When you do actually start investing, you really need to understand this definition from investor.gov. Asset allocation. It's just dividing your investments among different asset classes, things like stocks, bonds, and cash. It is not a one-size-fits-all formula. The right mix for you depends entirely on two things: your specific time horizon, so when you actually need the money, and your risk tolerance, meaning how much market swinging you can personally stomach without panicking and selling. I absolutely love the old saying, don't build your whole financial future on one tree. Plant a small forest. Spreading your money across different investments drastically reduces the risk that one single company's failure is going to ruin your entire portfolio. Look, diversification doesn't guarantee you'll never lose money, but it is the fundamental strategy for managing risk over the long haul. And that brings us to our final step, Section 5, the power of time, letting compounding do the heavy lifting. This final concept is the secret ingredient that makes this entire system work. According to investor.gov, compound interest is earning interest on your initial principal amount and also on the accumulated interest from previous periods. Put simply, it is the most important math in all of finance. You do not need to start with some massive lump sum of money to become wealthy. What you actually need is consistency, and you need a very long time horizon. Let's actually visualize exactly how powerful this is. Say in year one, you start with just $100, and you earn 5% interest, which is $5. Ending with $105. By year two, your starting balance is that new $105, so that 5% interest is now calculated on the larger amount, earning you $5.25, leaving you with $110.25. Do you see what's happening? The interest itself is generating new money. Over a few decades, this snowball effect accelerates your growth incredibly, literally doing the heavy lifting without you having to put in any extra physical effort. But people manage to derail this process all the time. So what are the biggest mistakes? Well, first, waiting for the perfect time to begin a financial plan. Let me tell you, there is no perfect time, there is only time lost. Second, chasing easy money schemes or guaranteed high returns. Remember, returns are never guaranteed in investing. Third, putting way too much money into one speculative asset or idea instead of just diversifying. And lastly, confusing a high income with actual wealth. Earning a ton of money means absolutely nothing if you just spend it all trying to look rich. So the crucial takeaway here is bringing it all back to Alex's journey, which is just this simple, repeatable loop. Earn your income, control your spending and that expensive debt, protect yourself with cash reserves, invest consistently with diversification, and repeat. The ultimate goal of this entire sequence isn't to flash expensive brands and look rich to the people next door. The true goal is lasting financial freedom. I want to leave you with a final provocative question to chew on today. Are you building actual wealth, or are you just building a lifestyle? Take a hard, honest look at your own system. Thank you so much for joining me for this explainer. I really hope this structure helps you take total control of your financial future, and I cannot wait to see you in the next one.